I'm John Hanna for CDTV.net in New York, and we have Dirk Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Thanks for joining us, Dirk. What a day yesterday, huh?
Oh, yeah, it was certainly a wild and crazy one, to say the very least, especially coming on the backs of all the declines we had last week. I think the problems are mostly from the problems over in Europe. Honestly, I don't think that the S&P downgrade is that big a deal. Uh, for starters, it's just an opinion on the likely ability of the U.S. government to pay back its debt. Now, the U.S. government can always pay back its debt as long as it decides that it wants to. Right? All the U.S. debt is denominated in dollars, and the government has a printing press in the basement that can legally print those dollars. So the thought that the U.S. would be unable to pay is categorically absurd. It doesn't matter if we are $14.5 trillion in debt or $114 trillion in debt. The only way that the U.S. can ever default is if it decides to default. Now, unfortunately, we came awfully close to making that decision a week ago. Right? There are actually members of Congress, people who are supposed to be governing, who were bringing up the idea that, oh, yeah, it's no big deal for the U.S. government to default. I mean, that should be the province of, bloggers who come up with those sort of statements, not members of the United States Congress. So there is this potential breakdown where all of a sudden the debt ceiling has become a political football. It never has been in the past. Yeah, I mean, maybe an opportunity for a little posturing from an individual senator saying things, casting a no vote, knowing that it's going to pass, with 75 votes or something like that. It was never previously a question. Now, I mean, personally, I wish that Obama, if he were smart, he would have invoked the 14th Amendment and told Congress to go shove it. Because this was just a very dangerous thing, and that's the only reason that S&P is taking this step. But I would remind you and everybody else that the S&P has not exactly covered itself in glory in showing that it's all that competent. I mean, after all, these are the people who had Enron rated AAA up until a week before it defaulted. Right? Add that on the top that they made a $2 trillion math mistake that was pointed out to them, and it didn't change their opinion. They used the wrong baseline off of what they were working off, and the amount of debt that they projected in 2021 was $2 trillion higher than it would actually be based on the scenarios. Now, $2 trillion is a pretty big arithmetic mistake to be making, especially by people who are supposed to be experts in this sort of thing. So, I mean, I don't think it's a very big deal, and quite frankly, the markets didn't think it was a really big thing. Because if you looked, right, what was rallying like crazy? U.S. Treasuries yesterday. We were, if somebody fears that a bond isn't going to be repaid, that is not absolutely certain, they're going to demand a higher yield. They're not going to all rush into that. But, regardless of what S&P says, U.S. Treasuries are always going to be the first place anybody looks when you have times of stress and you want to flee and, be first and foremost concerned with the return of your capital rather than the return on your capital. So we're at extraordinarily low interest rates. Now, I mean, if the Federal Reserve simply prints money, right, to pay off the debt, which is what I'm saying they always have that option of doing, is that potentially inflationary? Yes, it is potentially inflationary, but is the market seeing that is a potential problem? Not if they're saying that for the next 10 years, I'm perfectly happy with 2.4% in return. If inflation is over that, you now have a guaranteed certificate of confiscation in terms of your real purchasing power instead of an investment, right? And the bond market isn't filled with dummies, right? What they are saying is that inflation is not the problem. As a matter of fact, given this deleveraging cycle that we've got going on in the private sector, what it's saying is that deflation is still a much bigger potential problem over the next 10 years than is runaway inflation. So everybody's really on edge. It does look like growth is slowing down significantly, and that's what the market is sort of waking up to, that by this debt ceiling deal, right, where we're cutting spending, it's not so much the near-term spending cuts that are embodied in the deal are all that bad, but what they've done is they've absolutely precluded the government doing anything in response to any further financial shocks.
Closing statement.
So, I mean, in a sense, what we've got is the market realizing that growth is going to be slower. Even though we avoided the firing squad, right, we are now sort of facing a slower death by starvation, and that's why the market is down, not because of the S&P downgrade.
That's Dirk Van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio, and I'm John Hanna for CDTV.net in New York.